Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, May 24th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have futures down just a little bit. Dow futures down 86, S&P 500 futures down about 12, NASDAQ futures down 43. So on a percentage basis, all down about 0.3%. Of course, we have had a huge run to the upside with the S&P 500 finally clearing 4179. We've had the NASDAQ 100, the QQQ, moving to highs, 52-week highs, taking out the August 2022 highs. So we've seen a big move, and it is during the period where the market historically doesn't do so well throughout the typical calendar month. So I wouldn't be surprised to see a little bit of a pullback. I honestly was a little bit surprised, even as bullish as I am, that we made a breakout last week into options expiration week. But the market looks good. Pullback, I think at this point probably would be healthy. We want to make sure that certain key support levels hold. Rising 20-day moving averages would certainly be one thing that I would be watching. We got a little bit of room down to those. But overall, I think the market's been pretty good. I do want to mention, and I'll mention it again later in the show, but tomorrow at Earnings Beats, we're having a live trading day, or most of the day. I'm going to be going over our platform. I'll be talking about how to use our scans, how to use our chart list, the research that we do, and how you can apply that in your everyday trading. If you want to be part of that, I will give you a link later, but you can go over to earningsbeats.com and you'll see on our homepage a big icon with the live trading, and you click on that and it'll give you a little bit more information. It is for our annual members, so those who commit to us. I'm going to give you a full day of my time tomorrow, or close to a full day, to go through and talk a little bit about our platform, how I trade, talk a lot about reward to risk. So if those things interest you, make sure you go over to Earnings Beats and check that out. All right, let's move on to the agenda for today. So I'm going to go ahead and start off with the daily market recap. Talking technically follows. Chart of the day. I know I've gotten a number of emails about what I think of small caps and transports, and I've talked a lot about small caps. I actually think they're poised for a big move to the upside. I'm still waiting for the trigger. We're getting closer and closer at the end of yesterday, but we need a trigger to get a breakout out of the recent range that the IWM, for instance, has been in. But if we get that, I really like small caps, and transports is another area. Really hasn't performed well. So I got an interesting chart in the chart of the day I want to show you on those two areas. Then we'll go into earnings spotlight. Number of earnings this week. A lot of retailers, got some software stocks, but we're going to go through and take a look at some that reported, some that will be reporting, and then wrap up with the three you must see, three Dow stocks that haven't been performing very well. But is it time for them to come back? You might find those charts interesting, so that'll be at the end of the show. All right, let's go ahead and jump into the daily market recap. So on Monday, May 22nd, we had the Dow Jones Industrial Average down 140 points. S&P 500, though, was up fractionally, basically flat. And the NASDAQ was up 63. So this bifurcated action that we've seen with a lot of rotation towards NASDAQ continues. It would seem with interest rates moving up, that we might see a little bit of a reversal and money rotating a little bit more into the Dow and less into the NASDAQ. But so far, the NASDAQ continues to move up, even though yields have been climbing. The S&P 400 mid-cap index up about 13 points, small caps up 8. So on a percentage basis, small caps actually were the best performer yesterday. We've been able to move back up through both the moving averages, both the 20 and the 50. We're seeing the AD line pick back up. And on the mid-caps, the AD lines almost moved back up to new highs. And you can look at the NASDAQ, S&P, and Dow and see that we've already moved to new highs there. The AD lines look really good. I suspect as this market continues to move higher over time, and I do think it's going a lot higher, I think the second half of the year is going to be better than the first half. and the AD lines, I think, will go right along with it. But currently, mid caps, small caps have been underperforming. I think that's probably about to change, but we do need to see some confirmation first in terms of price breakouts. You can see the mid caps struggling to get through about 25.20. Small caps right here, maybe about the 1180 area, something like that. So we still have room to the upside on both of those. And this small cap index, the S&P 600, is a little bit different than the Russell 2000. The Russell 2000, the IWM, is sitting almost right back up against its resistance. But I'll show you that IWM chart in just a little bit. From a sector perspective, communication services was your leader on Monday, gaining 0.9%. Real estate, which had been beaten down, saw a little bit of a rebound there, up 0.2%. Then we drop off quite a bit, but technology up 0.2%. Financials also up about 0.2%. The loser, big loser yesterday is consumer staples. This group has really been dropping on a relative basis. It was down 1.51% yesterday. Consumer stocks didn't fare very well, and consumer staples really took the brunt of that selling. By the way, moving back down, closing below the 50-day moving average just a couple of days after closing below the 20-day moving average. PPO moving down pretty quickly, approaching the zero line. So this is a group that definitely, from a relative perspective, does not look very good. And I'll also take a look at that in just a few minutes. The 10-year Treasury yield, and as far as economic reports go, not a whole lot this week. Today, we will get the April new home sales, but we're talking April. I mean, we're getting ready to move into June. So it's a little bit lagging. A lot of the housing data is a little bit lagging. I like what I've been seeing on the home building housing chart. And so I don't really pay too much attention to the reports from a couple months ago. I don't know that they really influence the current market. Remember, the stock market's always looking ahead. So how much is it truly going to be influenced by a report that's coming out for 2 months ago? FOMC minutes will be out tomorrow. They come out at 2 p.m. Eastern. That is definitely something that could move the market. So you want to kind of at least watch around 2 o'clock tomorrow in the afternoon. We'll be looking at it in our live trading session just to get an idea of what might be taking place when those minutes come out. All right, moving on. Let's do a little talking technically. I have a longer term chart here. Well, just the last 3 years, daily on the S&P 500. So you can see 2020, 2021 was wonderful. 2022, not so much. 2023 starting to strengthen again. But I wanted to show you, more importantly, first you can see the AD line, which has continued to move up as if there's never been a problem. XLK, XLY, and XLC, all of them are shown here relative to the S&P 500. So I think you can see pretty clearly that the XLK has been a really strong relative performer this year. And when you see the market moving higher and you see the most influential, aggressive sector leading it, it beats you over the head that we are in a risk-on environment. And if you know much about bull markets, they are led mostly due to risk-on investors. If you look back at before we went into 2022 and just looked from 2013 to 2021 at that nice long secular bull market advance, technology crushed every other sector. Crushed. The NASDAQ crushed the S&P 500. That's what happens during secular bull market advances. I've been saying this is the renewal of the secular bull market. This is one of the reasons why. Technology continuing to power ahead. This isn't technology going up. This is technology outperforming the S&P. We know the S&P's been going up. Technology is dragging it higher. Technology is sprinting higher. Now, discretionary in this downtrend that's been going on for a while relative to the S&P 500, it's kind of been doing the same thing relative to the consumer staples area, but I got an interesting chart I'll show you. I showed it yesterday over at Earnings Beats in my Trading Places live show there yesterday. but I think it's worthwhile showing you again. It's a proprietary user-defined index that I came up with that ignores gaps, but I'll talk about that in just a couple minutes. Here's your communication services. It was one of the worst performing, well, it was the worst performing sector from September of 2021 through the end of 2022. But look what's happening now. We're having a really nice move to the upside. And this is your best performer in 2023. It's actually performing even better than technology. So your XLC, home of big internet names, you got Google, Netflix, Meta platforms. Those are the names that are helping to carry the XLC higher. And I don't see it stopping. I think this is going to be a continuing theme for 2023. Aggressive growth is going to continue to lead. Now we're going to have periods, pockets of pullbacks. That's going to be inevitable. Probably generally will coincide with rates moving up. That hasn't occurred as rates have been moving higher here over the last week or two. But generally, that is when we see growth stocks kind of pull back and take a little bit of a break. And I wouldn't be surprised if May and June are a period like that. We are into the second half of the second quarter. We know historically the second half of the second quarter is not as strong as the first half of the second quarter. In fact, the second halves of all quarters do not perform as well as the first half of all quarters, with one exception, and that's quarter four. When you get into the holidays around Thanksgiving, the Christmas holidays, market stays in a pretty good mood. The second half of the fourth quarter tends to be just as strong, if not stronger, than the first half. But again, that's the exception. The other three quarters, there is a very significant difference in performance between first half quarters and the second half of quarters. So I wouldn't be surprised to see some of the growth take a little bit of a pause at some point. My gosh, they've been straight up. I mean, just in any market, you would expect a pullback to some degree. But I do think they're making up for lost time. Many of these companies, if you look at the earnings that have come out, I mean, where are all the folks back a month ago, 2 months ago, that were talking about earnings were going to be so bad this quarter? I look at earnings every day. Every earnings report I looked at from yesterday's close was better than expected. And so everybody looks at this is what the earnings are going to be for the S&P 500. Oh, look at the PE ratio. And then the earnings come out and they blow away estimates. So I don't listen to all that. To me, it just gets you nowhere. It just confuses, muddies the picture, makes you afraid to invest. I follow the charts. Forget about all the other stuff. So that was the aggressive groups. Basically the same chart, S&P 500, 3 years. Now I want to show you the defensive groups. Since the beginning of the year, healthcare on a relative basis, just setting new lows. How about consumer staples? Went down January into early February. You can see it was rising nicely for about 3 months. That trend line broke. We're moving back down rather rapidly at this point. Utilities, they topped back in September of last year on a relative basis. Look where we are now. Pretty significant drop. How about real estate? Real estate's been horrible. Look at what's happening. Money rotating into the aggressive groups as the market rises, and it's coming out of defensive groups. The risk on areas are leading. Beautiful. I mean, until that changes, if the S&P 500 keeps going higher and we see the aggressive groups on a relative basis all roll over, let's go back to that chart. I mean, if we see this start to turn down while the market goes up, when the market pulls back or consolidates, it's normal for this to come back. That's the way the market works. When you sell off, you tend to sell off areas that you've profited from. That's going to be the areas that have been going up. It's normal when the market pulls back for the relative strength to drop. And a lot of people will look at this and say, well, there you go, Tom. There you go. The aggressive groups are dropping. And I'm like, yeah, but the market's dropping. That's normal. What isn't normal, and one of the reasons why I called the market top at the end of 2021 was because the market was setting new all-time highs and the aggressive groups were falling apart on a relative basis. That's telling me that what you're hearing on CNBC is not in line, it's not in lockstep with what Wall Street firms are doing with their money. That's when you need to be worried. Anyhow, we'll see this drop at some point. If the market's dropping, no big deal. If the market continues going up and we're seeing major rotation, yeah, that's going to get the hair up on the back of my neck. So far, I see none of that. All right, let's move on to the chart of the day. I do want to just point out for you, if you go over to earningsbeats.com and you scroll down, you will see this live trading room icon. And essentially, to be in this tomorrow, you do need to be an annual member. But there's a silver lining here. And the silver lining is that we are having our best deal of the year. It is our spring special. And so this is a great time to commit to us. If you want to lower your monthly cost, simply extend further down the road. So we're giving our members, and it's not just for new members coming in, anyone who's a member at Earnings Beats, if you want to extend, great time to do it. It's going to be the cheapest time you're going to get all year on a monthly basis. The longer you commit, the more money you're going to save. And also, anyone subscribing to any of these plans, 1 year, 2 year, or 3 year. By the way, 3 years, if you subscribe for 3 years, you're going to get a bonus year free. 4 years for the price of 3. It brings the rate down quite a bit. But if you're in any of these plans, or if you're a member and you want to extend, you can use any of these plans. But anyone who's an annual member, whether you're 1 year, 2 year, 3 year, 6 year, whatever, and we do have members now that are members out past year 2030. Because when we do these specials, they capitalize and just figure, Earnings Beat's going to save me the money or make me the money. That's been our history. But anyway, if you are an annual member, you can then join us for our live trading room tomorrow morning. It starts at 8:45 Eastern. So I'm still trying to decide what we're doing with our Wednesday Trading Places live show. It's probably just going to be eliminated for tomorrow. I was thinking about maybe doing it early, maybe for 15 minutes, starting at 8 o'clock or something like that. But I'm going to have my hands full, so I don't know if I want to do that or not. But we'll let everyone know when we send out our EB Digest tomorrow morning. It'll be in there, a link to the room if we're going to do our show. But this live trading room, I think you're really going to enjoy it. I think it'll give you a whole different perspective to how we look at the market and how we trade. We put together a lot of chart lists, a lot of scans for our members. I'm going to show you how to use it all and put it all together. So anyway, it should be a great event. Just wanted to mention that. And also over at Earnings Beats, we have the chart of the day. We have an Earnings Beats Digest, which is a free newsletter. And at a minimum, you should go over there and sign up if you haven't already. Name and email address. It's free, no credit card required. You can unsubscribe at any time. Monday, Wednesday, Friday is when we deliver it, usually around 8:30 in the morning. And it focuses on the things that are important to us: earnings, gaps, candlesticks, relative strength, trend lines, moving averages, things I talk about on the show. Obviously price volume combination. But definitely sign up for that. And that is, again, completely free. You can unsubscribe at any time. No questions asked. All right, let's move on. I want to talk now about this chart of the day. And so, again, a lot of questions coming in about the, actually, this is not the chart of the day I want to show you. Oh, this was, if you go back to the S&P, remember I showed you the XLK versus the S&P, and I said the XL or the XLY versus the S&P. And I said the XLY S&P looks similar to the XLY XLP, which is consumer discretionary versus consumer staples. And if you want to look at that, let me just pull it up here real quick. So in this same chart, this is a sustainability ratio that I like to look at. And you can see some would say, well, what about your favorite ratio, the XLY, XLP? It's been horrible. How can you say the market's going to go higher when your favorite ratio is going down? Well, what have I talked about since 2022? What's been the word that I have mentioned probably more than any other word? Manipulation. I believe 2022 was the year of manipulation. First of all, I thought it was the first 5 months of distribution. That was not manipulation. That was pure selling. Since May, all of this, the further the S&P went down, that was all manipulation in my view. Just the way everything was trading. We were gapping down, we were selling off in the morning, and then we're having massive rallies in the afternoon. That was not happening in the first 5 months of the year. It started happening in June, and it continued here. While we went to new lows, everybody thought it was horrible, and guess what? Wall Street was saying, thank you so much for selling us your shares. We want to thank you from the bottom of our hearts because we got in so much cheaper, and now look at what's happening. Now that they've filled their coffers, they've filled their stockings, and here we go. Market's been moving to the upside. It's a great system. Anyhow, getting back to that XLY, XLP. So there it is, right? I can't argue. It's been going down. It looks horrible. That made me think, what the heck is going on an intraday basis between the XLY, XLP? If the AD lines are going up throughout the bear market, it's telling us that overall market is finishing higher toward the end of the day. Is the same thing happening in this ratio? That's the question that went through my head. And I said, you know what? I'm going to find out. So we went back and we looked intraday at every day's action on the XLY and the XLP for the entire period that this was going lower. And you know what we found out? That if you ignore the gaps, this again is a user-defined index that I created at StockCharts. But what I did is I wanted to see what was going on during the trading day when Wall Street actually buys and sells. The big firms, they don't buy and sell at the opening bell. You can't put 1 million shares order of Apple in at the opening bell. There's no liquidity. The actual buying and selling of stocks by these big firms has to take place usually via market makers during the trading day. So what's the XLY, XLP look like? Here's what the XLY, XLP looks like. And I could go back 1 year and 6 months because that's about when I started doing the calculation. But here is this is what I calculated. Notice the first 5 months of last year and even the end of 2021, my ratio, my intraday ratio was going down with the market. But when we kept going lower to a new low in the real, the XLY, XLP ratio that includes gaps, we went to new lows in December. When we ignore gaps, we never went down to that May low. And then when we rallied in January on this ratio, look at what was intraday. We had a huge rally, taking out this double top, March of 2022, and then again in October, easily clearing any August issue, the August high. Big move up. And then this pullback that we were watching for the last 3 months, yeah, intraday, we never really had a pullback. It was going sideways. And guess what? We just broke out again. So you follow what you want. You believe the gaps are not manipulation? That's fine. Because that's part of what's going into all this price action, why the market went down. It was the gaps. It was market makers basically grabbing the herd by the noses and pulling them to the downside, making them bearish along the way, and then turning around and buying. At their market making units, they're buying after telling everybody what a horrible market it is. You need to sell this stock, sell this stock, sell this stock. And back in their home office, they're like, ka-ching, ka-ching, ka-ching. Anyway, spent a lot of time on this, but I think it's worthwhile spending that time on it. Here's the chart of the day. I got to go through the rest of this really quickly. IWM, IS, or SPY. Everybody says, well, market can't go higher. Small caps are underperforming. Here's a news flash. The IWM topped in 2011 relative to the SPY. That's right, 12 years of underperformance. So if you're waiting for the IWM to lead this market to the upside, I wish you the best of luck. It doesn't happen in bull markets. Just doesn't happen. Let's go down to the IYT. This is transportation. Yeah, they topped back in 2014, 1 year into the secular bull market. Been going down ever since. So if you're waiting for small caps and transports to come out and rescue you and lead this market to glory, it's probably not going to happen. Look at their absolute charts. Here's the SML, small caps. It's been going up. We went down too much in 2020, too high in 2021, but we continue moving up. Here's your IYT, transports. We're moving up. We're just not outperforming. It's not a bad thing. We've had the entire secular bull market under the same scenario. Yet now the media is telling us, oh, small caps and transports, they're not performing. Whatever. Moving on, earnings spotlight. Lowe's came out this morning. Wanted to point out, not so good to start the day. We also had, let me see some others. AZO, AutoZone, down $85, another 3% there. But this one's been on pretty nice uptrend. I wouldn't be surprised. It was a pretty good earnings report. They came out $34.12 in earnings versus $30.84. They beat by more than $3, more than 10%. Pretty good report. Stock down $84, probably going to reverse after the opening gap down. Zoom reported yesterday after the bell, down about 2.3%. Not horrible. The stock's been on a little bit of a roll lately. We'll see whether or not it can reverse after a gap down. And coming up, we're going to have some big reports. Intuit will be reporting. Actually, let's go over here and take a look. Intuit will be reporting. They look decent on an absolute basis, but not so much on a relative basis. A big one coming out later this week, NVIDIA. NVIDIA looks awesome across every metric. AD line, price action, relative price action, looks super. 3 you must see really quick here. 3M starting to show some strength. Is it going to finally turn? We are, a little bit below recent lows. I think it needs to get a sustained move through the 50-day. Maybe that comes today. I don't know. Then we got AXP, American Express, been downtrending. Another one needs to get through the 50-day moving average. Still got some work to do there. And then finally, Disney. Is Disney ever going to go higher? We don't know, but they've got great support down around 84, 85. I like that little hammer right near the March low, holding that support level. Maybe we can make a run back up toward 95 here. Anyhow, that's it for me. Appreciate you tuning in. I'll be back tomorrow with that all-day trading event over at Earnings Beats. Make sure you sign up. Have a great day, everybody. Happy trading.